Hi, this is Rob Beardsley. I just recorded an awesome episode with Brian. We talked about waterfalls, profit shares, and my favorite topic, which is investor psychology. So I hope you tune in and enjoy.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 497. There's a lot of noise in the commercial real estate space, but today's guest brings the kind of clarity that only comes from experience and execution. Rob Beardsley is the founder of Lone Star Capital, and in just a few years, he's built a portfolio of over $750 million in multifamily real estate. He's the author of 2 best-selling books on commercial real estate, a national speaker, and the host of the Lone Star Capital podcast. Rob is known for breaking down complex topics like underwriting, equity and debt structuring, and institutional operations, making them accessible to investors at every level. Today, he's here to share the strategies that have helped him scale, raise capital, and operate at a high level in today's shifting real estate landscape. Rob, welcome to the show.
Thank you very much.
Tell our audience who you are and how you got started investing in real estate.
I founded Lone Star Capital in 2018. So we've now been in business for around 7 years. And as you mentioned, we've acquired over $750 million in assets solely in Texas. So our investment thesis from the very beginning was to acquire in ideally primary markets and growing markets in Texas. So we were very attracted to the population growth, job growth, landlord-friendly dynamics that exist throughout Texas. And we started to build our portfolio in Houston and scaled it there, and also bought property in Dallas, San Antonio, and some other smaller markets throughout the state. And our focus has really been beneficial from a couple standpoints. One being our focus in one specific asset class, strategy, basically, and geography has allowed us to become local experts, build great relationships, and be able to take advantage of finding the best deals. And then similarly on the operations side, we really believe in the fact that you need to have a hands-on team, and it really helps to have a local geography to where you can be hands-on in a more logistically easy way rather than having a portfolio that's spread across the country. So that's really bode well for us. And then it's finally also bode well for investors because we've have really presented a coherent message to our investors where they can look to us as the Texas multifamily experts, and that's where they come to invest in that particular category. We're not telling investors, hey, come invest with us for stocks and bonds and multifamily and industrial. We're an expert for this, and we don't expect you to put all your money in one place. But when it comes to this, we think we're a great home for that. So that's been our strategy for the last 7 years.
I know Texas has been really hot and it's still a great place to invest. But obviously, over the past 2 or 3 years, we've seen a lot of turbulence in the market. A lot of talk about how Texas and the property taxes they go up every year. Here in Michigan, they're capped. So once you have your taxable value set, it can only rise, a certain amount each year. But I know Texas is different. So talk about some of the headwinds that you faced investing in Texas and how you've dealt with them.
It kind of speaks to why you really need to be a localized investor to know the specifics of your market. And so, for example, in Texas, absolutely taxes are a tricky situation because they are litigated essentially every year, and you have to protest them, negotiate down the value in order to keep your property taxes in check. So this is an added risk associated with Texas investing, which kind of offsets kind of the positives associated with the growth and everything. And specifically, the way property taxes work is, generally speaking, the assessor's office looks at the income of the property to derive its value, very much the same way that an investor looks at commercial real estate through a cap rate, right? How much income does the property generate? then that's what it's worth. So the taxing offices look at it very similarly. So if you're getting big rent bumps, or if you're going in there and spending a lot of money to do renovations to increase the rents at the property, you can similarly expect your taxes to go up as well. So, and that cuts both ways because, as you mentioned, Texas has really been one of the best markets in the country as far as growth. So it's kind of taking up the headlines. And so taxes going up very quickly as well when values are rising and when rents are rising. But like you mentioned, the last few years have been turbulent to say the least. And so we've seen rents go down in many instances. Certainly values have come down substantially and have really, for the most part, stayed stagnant and declining for the last few years. So property taxes have followed the same. So property taxes lag a bit, but they do still follow that trend. So we've actually seen many of our properties' tax assessed values go down over the last 3 years, given the dynamics in the market.
How about insurance? How are you dealing with that? And then also the interest rate situation. I mean, are those headwinds that you've had to deal with?
Another, I would say, principal risk of Texas is insurance. I think insurance is really a headache and an issue across the country, but certainly insurance rates are generally higher in Texas because the weather is less forgiving on the real estate. We have weather risk down in Houston by way of hurricanes. You've in kind of more like Central and West Texas, you really have, in North Texas, you're ravaged by hailstorms. And so your roofs are not safe. So those things, those events drive up your insurance premiums because, of course, the insurance company wants to make money and they want to be covered based on all the losses that they're seeing. So we had a run up of insurance prices kind of, I would say, peaking in perhaps 21, 22, kind of in lockstep, funny enough, with the peaking of valuations in the market. But those two markets are not totally correlated. They have some correlation because the cost of construction factors into the cost of insurance, because insurance companies, it's a whole complex world where, there's an insurance company and then they purchase reinsurance, and then your insurance broker is building a tower for you of different layers of exposure and so on. And at the end of the day, everyone is looking the situation as to how they can make a buck. And so when insurance companies are pricing replacement costs and they're seeing rising construction costs, they have no choice but to increase their insurance rates to offset their underwritten losses and make sure that if they're paying out a loss to you, that they're still being able to make some money on their premiums. So as we all know, construction costs have risen a lot over the last while, which has been one of the contributors to rising insurance costs. But then the other thing is just big losses. And especially if you have things that happen that were not expected, that's really what upsets the apple cart. Is when if everyone's expecting a recession, we're going to brace ourselves and we're going to be okay. Or like a boxer, a boxer doesn't get hurt by the punch that they see coming. It's the one that catches them out of the blue and then they're knocked out. And so when the reinsurance companies, like over in London and all that, they were expecting, I don't remember the exact numbers, but 75 billion in losses or something. And then we had $100 billion loss year 2 years in a row. What's their reaction? It's a gut reaction. We need to raise prices. And so things, just like any market, the insurance market is cyclical, and we've seen the rates go up. And now we've seen, this year will be, the second or third year in a row that rates have actually come down on insurance. And so that's a long explanation to basically say, we don't really have much control over insurance costs, and they are a bumpy ride. And it is absolutely a risk where you don't want to get caught offside and underwrite an insurance price in your model. And then a year later, 2-3 years later, insurance is double, which is exactly what happened to many buyers who purchased their property in 2020, 21 in that era.
I've heard you speak and I've read your book, and I know you're very analytical and thoughtful. And I think the word that comes to mind is institutional. Like you operate at an institutional level. And I'm wondering if you can share with our listeners and our viewers, like, what does it mean to operate at an institutional level, and how does that inform the way you go about doing your business and investing in these multifamily apartments?
So that's kind of a core thesis, or just something very important to our business. And the way that we look at it is, yes, we invest in Texas, but we're actually the corporate team is actually here based in New York. And so New York is kind of like, the center of the universe when it comes to finance and the flashy Wall Street type stuff. And kind of taking a page out of that book, we felt that it was really valuable to just show up every day in a very professional way. There really takes no skill to respond timely to emails, to show up on time to things, to work hard, to be professional, to be presentable, et cetera. And so we found when we started in the business, and I'm sure you've seen this too to some extent, not everyone takes the same approach. Real estate's a little bit of the Wild West, and you kind of have characters of all types. And so we saw that as kind of an opportunity to stand out in a way that seems kind of easy and obvious, but still it really does work, and it's a big thing, especially when you talk about the retail world. And I'm assuming that you raise capital and have investors, and they're probably not AIG and insurance companies and pension funds, right? They're probably individuals who are investing their savings, and we have the same. And so while we have experience working with family offices and private equity firms and getting that institutional experience of investor, we really focus our business and our relationships with the retail investor, but with the caveat that we want to take the way that we approach institutional investors and treat them and are transparent with them and show them the numbers and the sophistication. We do that the exact same way as we do with the retail investor. So we want to provide that institutional experience for the retail investor.
Given that, what you just said, take us through the process, like deal structure. Let's start with that. Like, how do you typically structure your deals that applies those institutional ethics or whatever you want to call them? And I know, and also I want to make sure we talk about waterfalls and explain what those are too.
In the institutional world, there's some variation in deal structure, but you're going to see, I would say, a greater standardization. People are all kind of speaking the same language. Like you mentioned the word waterfall. In the institutional world, when you're looking to raise money from big names like Pearlmark or Goldman Sachs or, these sorts of names, there's going to be a preferred return which kind of prioritizes a return of capital and a minimum return rate to the investor before you, as the manager of the investment, can take a share of the profit. And so this is very standard. This is very fair. And then there's kind of some nuances and tricks where in the institutional world, these waterfalls have been standardized to kind of be more favorable to the investor and protect the investor, which I think is fair and it's a good thing. So for example, the preferred return is 9 times out of 10 going to be cumulative and compounding and subject to a return of capital. And so these are all good, positive things for investors, and it's very fair because an investor should, of course, be compensated based on the time value of money, right? Because money is not equal. If I told you, hey, I'm going to give you $100 today, that would put a big smile on your face. But if I told you I'll give it to you in 10 years from now, you'd probably shrug. So having a cumulative and compounding preferred return, that's important. And then having an equitable waterfall that is kind of within market standards. And when I say waterfall, I mean a share of the profits above and beyond the minimum return rate. So for example, in the institutional world, it's fairly common to see something like an 80-20 split, where 80% of the profits go to the investor, 20% of the profits go to the manager. And that would be after satisfying a 9% or even 10% cumulative and compounded preferred return, which is basically an IRR hurdle. Whereas in the retail world, you'll see everything. You'll see every kind of structure. And this is kind of, I hate to be a little cynical about it, but this is where you see sponsors take advantage of investors who aren't in the business and don't invest professionally. So they don't know, they haven't seen a bunch of waterfalls and they don't know really what's normal. And so you see sponsors charging kind of really out of line fees, whether it be an acquisition fee or an asset management fee or hidden fees of sorts, or maybe a disposition fee. And then there could be waterfalls or basically profit sharing splits where there's no priority given to the investor and it's just a straight split before a preferred return and so on and so forth. And so I say that with a caveat also that just because a sponsor is doing something that's maybe non-institutional doesn't necessarily mean that it is evil or taking advantage, right? It could just be a more creative or simplistic structure that's easier to explain, easier to understand, and still equitable. So I'm not saying if you don't do an institutional structure, you're evil, but that's just, unfortunately, it opens up for that possibility. So that's something that we have, of course, observed in the market, and we have deliberately chosen to kind of keep our structure more institutional and therefore appealing to kind of a wider audience of a first-time investor investing 50,000, as well as a billionaire family office.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. Take us through the institutional structure, and how it's changed over the years, because I'd imagine there's a lot that influences what the return rate will be. I mean, obviously interest rates, insurance, taxes, things we've already talked about. But how has it morphed since you've started in this business, as far as returns and structure?
There's kind of two groups of institutional investors, and it's tough to really just bifurcate it into two groups, but my point is there's the groups that are looking for opportunistic returns, and so they're really looking for those special deals. They don't mind the added risk of an associated deal because they're relying on their expertise in being able to kind of sift through the noise to find those really unique deals. But with that comes the desire for enhanced returns, right? They're not looking for extra risk and to, partner with you across the country. They might be, here in New York, but they found a great deal in Oregon, and you're going to manage that deal for them in Oregon, and you're going to generate them an awesome return, right? They're looking for that awesome return. And so they are really looking for that needle in the haystack. And so those sorts of situations, you're going to see the structure be perhaps certainly a lower fee structure than what someone would be used to in a more retail investment. So instead of a 2% acquisition fee, for example, it might be 1%, because really the investor or the investment manager is looking to put up the majority of the capital, right? They'll put up 90 or 95% of the money for the deal. And so they're going to really put the burden on you to perform. So they don't want to make you fat and happy on fees. They want you to really go and perform and go get that, 18% return for them. And the reason for that is because those funds are often structured where basically they are a value add fund and they're looking to deliver a 15% return for their investors, roughly speaking. So obviously, mathematically, if they're looking to give their investors 15% return, they're not going to do the work for free, right? They're finding the deal. They're going to kind of manage the sponsor. And so they're probably going to need to find a deal that will give them an 18% return so that they can then take their fees in their waterfall and then give their end investors 15%. And what that means is, as the sponsor has to find a deal that probably is a 22 or 23% return. And like I said, that's really forcing the sponsor to find a needle in a haystack, as well as find a deal that has a higher risk profile where there's more expertise, more effort required to pull the deal off. And also, of course, things are more likely to go wrong. So that's one structure. And I'd say you asked kind of how that has evolved. I would say that these sorts of investors and terms, they follow the market very closely based on demand, right? Everything's about supply and demand. And so when the market was hot in 2021, for example, there was a frenzy of activity. And so these sorts of investors were getting competitive. And so they would find a deal, but one of their competitors would also find the deal. And the sponsor would have the choice, two term sheets. I've got investor A and investor B, and things would get competed against each other. Oh, who's going to offer me a higher fee for the deal? Who's going to give me a bigger share of the profit? And so terms really kind of swung in the sponsor's favor. And then you saw a complete vacillation going back to the investor's favor because kind of all the money exited the market when interest rates went up a lot in 2022. And then sponsors were looking around hat in hand and they couldn't get any money. And so if an investor were willing, they could name their price and name their structure. So really the structures wax and wane with the demand of the market.
You said there were two types. So that, I mean, it seems like the first one you just described is like the institutional. They've got the money. They're really looking for those juicy returns. What's the other type?
So the second type is kind of the opposite, where it's more of like a capital allocator, and this is what really is true institutional. The former that I described, I would really call more of like middle market private equity. And so these are groups that are investing like $5 to $25 million per deal or so. And so that's considered the middle market. And truly institutional, I would say, is people who are writing minimum checks of 50 million and up. And so this could be like Starwood, for example. Starwood has various pools of capital, but they do have a value add pool, which would kind of fit more the former, but they also have like a core plus or institutional bucket, which is a $50 million minimum. And they're just looking for the trophy assets, the stabilized deals. They don't want a lot of leverage. They don't want a lot of risk. They want to hold the deal long term. They're not as IRR driven as the former investor type. So this is a really wonderful type of capital because it's more patient capital. It's capital that's not, like I said, targeting the highest returns. So therefore, you don't need to dial up the leverage. They're probably leveraging at around 40, 50% or so. And the expectations are a lot less. So the trouble with that capital is you kind of have to be in business for 20 years to earn the opportunity to work with a capital source like that. Because again, they're not looking to find the needle in the haystack or to have you slave away on doing some big turnaround where you're fixing mold and crime elements and things like that. You're buying a trophy asset and kind of setting it and forgetting it.
What are the returns that are achievable? And we're talking at the end of Q1 2025. I'd imagine the returns that people are targeting now are a lot different than what was being targeted 3 years ago.
I love the opportunity to get real because there's so many projections and there's all this talk about, well, my friend just got a 40% return on a deal, and oh, well, my friend got 60, and so there's a distortion and kind of expectation, and obviously, things happen in the short term that can make you really believe in something, but essentially, just as I mentioned, there's an insurance cycle, there's a supply and demand cycle, right? So there's also a return expectation cycle. And so it's pretty straightforward that as prices rise, generally speaking, throughout the cycle, projected returns go down actually, right? Because if you're buying in when prices are higher, your prospects for returns go down. But if you're buying at a time where prices are lower, which we believe is today, then your prospective returns are actually higher. The funny thing about this is, while that's super logical and easy to understand, right? Well, if I'm buying in high, I'm probably not going to do as well if I'm buying in low. The funny thing is, though, is it runs completely counter to our psychology and to recency bias, because as the market improves and prices go up, optimism rises as well. And recent results get people excited. So as prices rise, people might sell a property and they might get a 20% return, 30% return. And they might think, wow, this is great. This is magic. I can do this again. And so then they invest again with that same expectation, where in reality, if you just sold a project for a 30% return, you might think to yourself, well, prices maybe have risen and maybe if I invest at this point in time now, maybe it's going to be more likely a 15 instead of the 30. And then it goes on and on. But unfortunately, investors don't think that way, but that's kind of the whole difficulty of investor psychology. So let me rewind kind of to 2021, 2022, which I would consider the peak of the market. At that time, it was, pretty accepted, at least in the retail world, that prospective returns for multifamily value add in a growing market was around, call it 16% IRR over a 5-year period. So you could roughly 2x your money net to the investor. And the unfortunate reality is, while we couldn't all see it, we could maybe feel it, but not know for sure. That probably was not true because prices were very high and values were stretched, and the assumptions to achieve those returns were very speculative. So in reality, we really should have been telling everyone and ourselves that, you know what, it's probably more like we could 2x our money in 7 years, 8 years, maybe even 10 years. Returns are really thin at that point when the market was at its top. Now that prices have gone down, investor sentiment is very negative because prices have effectively been going down for almost 3 years, basically. So investors may be thinking to themselves, gosh, this multifamily investing stuff, it's not for me. I tried it. It's not going well. I'm not getting distributions, or I'm not getting the returns that I had hoped for. And, if I invest in a new deal today, it's probably going to be a dud just the same, right? Which is funny because the investor should be thinking the exact opposite. If they could overcome their investor psychology, they should be thinking, and here's the truth, if I invest today, actually I can buy higher quality real estate than what I was looking to buy before, and I can project a higher return than what I was projecting before on that exact higher quality real estate. So it's really, today at least, is a fabulous time to invest. I think realistic return expectations on kind of class A property in growing markets, I think is something around, like, call it a 12% IRR net to investor. And then if you're going for more risky, if you're buying older property that's kind of more value add and it's more of an opportunistic business plan, I think you can push those returns up to 15 to 16. So I would say the range is, if you're buying amazing premier real estate, then it's probably like 10 to 17% would be your range of expectations. Again, of course, that's no guarantee, because when you take more risk, yes, the return projections might be higher, but the actual results will vary.
What's your perspective when you look in your crystal ball? Like, what do you see for the next year or 2 or 3 years as far as multifamily apartment investing?
Yeah, I think we're at a very interesting time because we have a new administration. We have a ton of uncertainty because we have tariffs, we have Doge, we have so much change happening. And at the same time, we've gone through a very difficult period where, maybe the economists on TV aren't saying that we've been in a recession, but it feels like we have been in a long recession. Grocery bills are higher, cost of living all across the board is higher, rents are higher. So, I feel like the average American has been impoverished substantially over the last 3 years. And while the data may not plainly show a recession, I do believe that is effectively a recession. We've kind of silently taxed the middle class and the poor through inflation, and so goes the story. So with all that being said, I think it's troubling because I think there's a lot of positivity moving forward that, we've got new administration, maybe these tariffs will work, and maybe Doge will make the country more efficient, and AI, and there's all these things that, maybe will help and maybe will work. But at the same time, it does seem like consumer sentiment has only weakened and weakened. And we could actually, even though we've been in this silent recession, if you will, for the last while, we could actually enter into a traditional recession, or we could be actually starting one right around this time. And which I'm not going to bemoan that, but that certainly wouldn't be great because as a multifamily investor, I rely on my tenants' economic well-being to be able to pay our rents, and so that the whole thing can function. So I benefit, as well as all multifamily investors benefit, from a robust economy where they have jobs, they're getting new jobs, they're getting paid more, and so on. So I'm skeptical about that, which is not good for multifamily. A recessionary environment is not good for multifamily. Do I think it's totally destructive? No, I don't think so. I think that multifamily is a relatively stable and resilient asset class. So I think that out of your options, I think multifamily is going to do pretty well during the recession to the extent we have one. And then kind of the positive end of that to kind of counteract that is the supply and demand picture. And this is where things get really optimistic, in particular for multifamily, because we have gone through a massive wave of building where when interest rates were low and construction money was really cheap, developers were building, and we had a record level of apartment construction in the country. So a lot of cities around the country have just been absorbing those new units, absorbing. And when a market is absorbing new units, it's very difficult for occupancies to grow and rents to grow because the whole market's busy absorbing the new. But the interesting and exciting thing is construction costs remain high, interest rates remain high, and land prices remain high. And at the same time, values remain low. So all those factors make it very unattractive for a developer to build new apartments today. And this has been true for now the last 3 years. So there's been very little new apartment development going on. So we're going to go from a supply glut to a supply shortage, really starting at the end of this year, depending on which city you're talking about, because of course, different cities were built to a different extent. So I think that perspective is one big reason to be very optimistic about the performance of multifamily, specifically from an occupancy and rent growth perspective.
How would people find out more about you or, get a hold of you?
The best way to learn more and get in touch with us is on our website. That's lscre.com. That stands for Lone Star Capital Real Estate. So that's lscre.com. On our website, we have a bunch of great information. We have a free download for our fund manager underwriting toolkit. So there's a bunch of free resources there to analyze your own deals, kind of do like a walkthrough with me on a recorded video and so much more. So I look forward to people checking that out.
What's your favorite hack or app?
Yeah, I think this one's pretty practical. So I use a workout app because it's just basically a simple timer and you can set it to whatever interval you want. And so if I'm lifting weights, then I set it to 40 seconds. So I'm lifting weights for 40 seconds, which the studies show that 40 seconds is the optimal muscle building set. So if you do 10 reps for 40 seconds, you're building muscle. And then the optimal rest is 60 seconds. So I work for 40 seconds, then I rest for 60 seconds, and then it goes back and forth, back and forth. I remember when I was a kid, my friends, we would come home from school and we would work out in my garage gym and we'd play music and we'd chat and we'd kind of go back and forth and hang out, and a workout would be 2 hours. And, never mind that, people want to rest extra long so they can do more weight and stuff. For me, my busy schedule, I need to work out in 20 minutes. I need to get in and get out. And so this timer just keeps me right in check to where I'm just making sure that I'm working when I need to be working and then I'm resting for the next one. And this same timer app, and you can download any timer app, so I'm not promoting any particular one, but this can be applied to stretching. For example, the research shows, again, going back to the research, that stretching for a period of 30 seconds is optimal. And so I have on the same app, I have a timer that just basically is a ding every 30 seconds. So then I touch my toes for 30 seconds. Then I do back bends for 30 seconds. I stretch my quads for 30 seconds and you get the rest. So yeah, I think it's just a nice way to kind of stay on top of things.
Which timer are you using?
It's actually a boxing app. So it's called Boxing Timer. And so it just looks like a glove. And so yeah, it was inspiration from boxing, because obviously boxing is, 3-minute round and then minute rest and whatnot.
I'm really glad you came on the show today to talk about what you do in multifamily in Texas and your outlook on the market and just the institutional perspective you bring to your investing. I've really enjoyed this conversation, and thanks so much for having it with me today.
Yeah, I appreciate it as well. Thank you so much.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIG investor.com. And you can also ask questions questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.